With monthly expiration right around the corner, along with some overnight selling, we had a good deal of volatility that hit the markets. Now, this volatility for us translated into morning activity, letting us know by 7 a.m. Pacific which markets we'd like to ignore, along with which markets we'd like to focus on. Shortly after, when the morning volatility note was sent out at 7:30 a.m., today we knew, for example, that the S&P and the Dow were markets we'd like to ignore in terms of volatility, which I think is a more powerful part of the equation, knowing where you shouldn't focus. And we knew the two markets that we could still trade in terms of they were inside of our volatility box models were the Nasdaq along with the Russell. So in today's video, I'm going to talk through the signs that we knew that, hey, this is the market we'd like to ignore, how that translated the rest of the day in terms of was that a good move to keep us out of the markets or did that affect anything? And then we'll take a look at the NASDAQ and the Russell, breaking down the actual places where we had a trade set up. So starting off here first, the S&P broke outside of the doomsday conservative models early on in the morning. This is between that 6 to 7 a.m. Pacific hour when we're just observing. And that was our very clear sign that, hey, beyond this, we don't really have any other model that we can adjust with. We don't have a good edge here with our fades. So the S&P made the list of markets we'd like to ignore. We take a look at what happened had you, for some reason, stayed aggressive inside of the doomsday conservative models. And really no breaches until the end of the day. You did hit towards the edge of the hour and continue to go outside of the clouds, which would have been a stop had you been still continuing to trade inside of the S&P market. So we'll call that one winner in the idea of not focusing on the S&P market did end up keeping you out of trouble later on in the day. Now the story is not the same when you switch over to the Dow. However, this was another market we ignored as well. So the Dow here in the morning, we had a breach of our sign entry line. So very similar here. We're looking for price action to stay inside of the clouds here and for the sellers to be able to take control and show us that, hey, they have some level of control. Now, if price action goes outside of the clouds first, which is what happened in this case, then that's our sign that, hey, the buyers have too much control here. We'd like to adapt one more level if we could, but the doomsday conservative models are the last ones we have, and thus the Dow is a market which we're going to ignore in terms of our focus. Now, if we take a look to see what actually ends up happening, in that 7 to 8 a.m. Pacific hour, we have a breach and a nice bounce from there. So this would be one of those trades that we would have liked to be part of, but the fact that we ignored this market kept us out of it. So we'll call that one ding. And then if we keep going here after that with a nice bounce, you had a retest, a similar double bottom where price action still hit those cyan entry lines, and then reversed, hitting the top end of the volatility box as well, but this time went outside of the cloud. So really you had one and two trades, both of which had the breach along with the edge signal, but never did get the retest. So not a real opportunity that would have panned out. But in terms of seeing a nice bounce from these levels, that did still take place. And the short here, had you actually taken that, would have gotten you into more trouble, very similar to the S&P here. So that's what ended up happening with the two markets we ignored. So I wouldn't call it in terms of opportunity lost, that there was significant opportunity lost there. However, what was gained was the ability to focus down on only two markets. So if we now switch over to the NASDAQ, unlike its counterparts, was on the aggressive volatility box to start off the morning here. So now the aggressive volatility box is what's leading us in right around 7:30. That's the model we know at least confirmed in the morning volatility note. Then price action continues to chop around sideways. Now in that 8 to 9 a.m. Pacific hour, we see a bit of volatility hit the markets when we breach our cyan entry line. So that's step one of our trade process. We'd like to see this happen. Another thing to note, it's near the 1618 extension, and this is from the Feb to March decline. So it's a fairly large extension, but that's step one. Step two we're looking for is the edge signal, which comes right here with the red arrow. And after that, we need a retest of the cyan line, which we do get for the trade to be valid. And so that's pretty much it in terms of the one setup on the NASDAQ. Our risk here was right around 32 points, distance from the cyan line to the outer edge of the clouds. And we're looking for the same 32 points on the opposite side, which took a bit of time to actually play out. That did not happen in this down move. We had a bit of a retest near your actual entry price before having the ultimate flush move down lower. And once we had that happen, the stop on the remaining contracts after T1 was at the cyan entry line. And that then gives you the ability to go for T2 at the gray target line, which is what ended up happening in the NASDAQ's case right here, which is right around 63 points. So that's trade number one inside of the NASDAQ. Now, our second breach that took place was not between the 11 to 12, but rather towards the edge of that 10 to 11 a.m. Pacific hour, where price action breached the cyan entry line. This was towards the edge of an hour, so per our trade plan rules, that's observation only, free information. We see here price action goes outside of the aggressive clouds, and that then takes us to our doomsday aggressive models. Now, switching over to the doomsday aggressive models here, we come right back into the same period. We have a breach, we have the edge signal, but we never get the retest for the final setup. And then again, breach the edge of the hour, and this takes us into the conservative models as well. And that's pretty much it in terms of breaches. So the one actual trade setup that met all of our rules, our trade plan, all of that, was the short setup early on in the day. If you chose to continue to be aggressive and not switch boxes, then you had a second setup in that 11 to 12 p.m. Pacific hour, which gave you T1 and T2, but was definitely a more aggressive setup in which you were ignoring that previous edge of hour rule switch to the doomsday aggressive models. All right, so that's the Nasdaq. And then finally, we have the Russell here. The Russell here, to start off the morning, we were on our scalper volatility box models. And that's what we had leading up to right around 7:30. Now, after 7:30, price action continued to sell off here, going outside of the clouds. This is before we had the edge signal confirmation, so this is still free information, no capital at risk. That takes us from the scalper to the aggressive volatility box models. That's our first switch. We're adapting to volatility. Price action there breaches our sign entry line. We have the edge signal confirmation, but we never get the retest prior to hitting the first target. And so that's the first trade that takes place, pans out, but doesn't give us an opportunity to enter. Then the second trade is a short at the 8 to 9 a.m. Pacific hour edge. We have a breach, and that too ends up hitting T1, but one more time towards the edge of an hour. So this is so far two opportunities that we've seen pan out in terms of hitting their first target, but haven't met our trade plan rules in terms of giving us an entry. The third setup is where we finally have all of those pieces come together, where price action falls inside of our sign entry lines. We have the edge signal. We have an opportunity to enter at a price better than the sign entry line. Our risk here is from the sign line to the outer edge of the clouds, right around 5.7, 5.6 points based on how conservative you were. And we're looking for that same move on the opposite side, which we get to move all the way up to 5.8, so inside of the range before price reversing and all remaining contracts being taken out at break even. So in the Nasdaq, we had T1 and T2s, but in the Russell, only a T1. Now, once price reversed here, we went outside of our clouds, even the aggressive, and that then takes us to adapt, where into the rest of the day, we had to keep adapting down to our conservative clouds. And conservative was finally the only one in which our rules were being met and no other breaches for the rest of the day. So hopefully this video helps to give you an idea of how in the S&P and the Dow, there were some breaches, but no real opportunities that met our rules. In fact, in the S&P, we stayed out of trouble by knowing which markets to ignore early on in the morning. This was by 7:30 a.m. Pacific, so less than an hour after the markets opened. And then we knew the two markets where we would like to pay a little bit more attention, and that was the Nasdaq along with the Russell. And in both places, we had setups. The Nasdaq was a slightly nicer setup in terms of giving us a better T1 and T2 ratio, with 63 points being that second stretch target in the Nasdaq. And then in the Russell, we had smaller T1 winners only, but we had to be patient for the breach, but we did get the breach, which finally met our rules. All right, hope this video helps. Take care, everyone. Good luck trading, and we'll see you in the next update.